All right, let's delve into the characteristics of each one of these types of business structures. All right, so let's go ahead and start with the sole proprietorship. Then we'll review the partnership, and then finally the corporation. Okay, so sole proprietorship, it has to have one owner. Partnership, two or more owners. And a corporation can be one or more owners. Okay, so sometimes on the multiple choice, it might be a little tricky because there's two business formations that could have one owner. So you really have to look at the other characteristics that are mentioned to see, are they leading us towards a sole proprietor structure or a corporate structure? So let's review some of the other characteristics. So sole proprietor, we said it is easy to form, easy to form. There really is no paperwork required. There's some recommended, but there's none required. If you just start selling things out of your garage, that's a sole proprietorship in terms of the business structure. Partnership, medium difficulty to establish. Because again, you at least have to find someone else who wants to go into business with you. And then there's some recommended paperwork that you guys fill out, like how you're going to share your profits and losses, right? So it's recommended that you establish some paperwork. And this one is the most difficult and costly to set up. And costly to set up. So you really have to have some forethought into, okay, I want to make a conscious effort to incorporate because of the amenities that are offered by this type of structure. I know it's going to take me probably years to do and thousands of dollars to incorporate, but I think in the long run, that's what's going to be best for me. So let's talk about some of those advantages. So the first advantage of a corporation is it is a separate entity. And by it being a separate entity, it offers a few advantages. One, it has a continuous life, meaning if the owner, the original owner, loses interest in that business and kind of wants to do something else, the business can continue, right? Look at the Ford Motor Company. That was created in 1903. So it's been around for like 119 years, right? And obviously the founder, Henry Ford, is not around anymore, but his business continues on. So its life is separate from the owner because it's that separate entity. So it can continue on after the owner passes away or after the owner wants to retire, it can continue on. The next one is that it shelters its owners from liability. So it offers liability protection. Sometimes you'll hear this referred to as limited liability. Okay, meaning it limits the liabilities that the owners have, it limits their risk. It limits it just to whatever their investment is. Their personal assets are never at risk under a corporate formation. That's not going to be the case. Those two aren't going to be the case with the first two structures. So it is not a separate entity for the partnership. Okay, so it's not separate from owners. From owner or owners. Okay, so this means it does not have a continuous life. Okay, so it's said to have a limited life. Okay, so not a continuous life. So meaning when the owner says, yeah, I'm done with this. I don't want to sell my bakery items anymore. Even if your customers are like, no, we want them. If you decide, no, I want to retire, I want to do something else, then your business ceases to exist. Unless you wanted to, sell the name to someone, but then it would be a new sole proprietorship under that person and tied to that. All right, the other thing has to do with that liability, right? The corporate formation offered protection for your personal assets. This one doesn't, so it's said to have unlimited personal liability for the owners, and that is a very real risk. Okay, so if the company gets sued, you made your baked good and someone choked on it and got very ill or food poisoning or something, and they sue you, they're going to sue for all the assets of the business. They're going to come after the business. And then you, as the owner, all your assets, so here's your upset customer who got sick and they're very mad. They're going to sue the business. And then if the business doesn't have enough assets to fulfill their legal claim, if they're successful, they get to come after all your personal assets. So the first two business formations do not shield the owner from personal risk. And so that's one very real advantage of that corporate formation. All right, let's talk about taxation now. The first two entities, your income is passed along to the owner, passed to owner or owners, and taxed at their level, at their personal level. Okay, whereas with a corporation, the income stays, because it's a separate entity, income stays at corporate level, and is taxed at the corporate rate. Taxed at corporate rate, which are usually lower than the individual rates. Okay, so if you own a business, all that income is treated as yours, and so you will be taxed on it on your personal 1040 tax return at the end of the year, whether you're a sole proprietorship or a partnership. The corporation is going to fill out its own tax return. What is it? Not an 1120. Drawing a blank on the tax form right now. Oh, well, you'll learn that in a tax class. So they have to fill out their tax return, right, for the corporation. All the other individuals, the employees, the owners, the shareholders, they're going to have to fill out their own tax returns separately because it's a separate entity. So the corporation fills out its own tax return and is taxed on its income there. All right, I think those are all of the characteristics of the different types of business entities. There is a practice exercise for you to try on this, and then you're also going to have an assignment for showing that you understand the differences between these three corporations. Let me know if you have any questions. You can send them to me or post it to our class discussion board. Thank you.